Hey everyone, it is Ian, and today we're going to be going over something that we discussed a little bit in previous videos, which is basically using correlation to find the most optimal trading strategies. I'm going to touch upon that later. What we're going to talk about first and foremost, though, is this trade idea that I came across earlier today and have been following this market for past couple weeks, really in depth, and that's the natural gas market. This is on ticker symbol BOIL. This is basically ProShares Ultra Bloomberg's natural gas ETF. Um, they hold futures contracts, mostly short-term futures contracts. From what I saw, they actually only hold November futures contracts, which just for me, this makes it even better because a lot of what I want to get exposure to is basically implied volatility, and the volatility that we're currently seeing in the natural gas markets because I don't really want to get further out because there's some risks. I'm going to go over those risks in a sec, but first let's just go over what we're seeing, which is we're seeing a clear sign, in my opinion, at least a clear sign of consistent premium over the past couple of months. Began seeing this dispersion between implied volatility and realized volatility right around August or so, mid-August, and this persisted. I think a lot of this is due to the drama that is going on with Nord Stream One, with the Nord Stream One pipeline. I think that's been expedited in the past couple of weeks with what Russia has, done with that pipeline since. Basically, a portion of it was blown up, so there is obviously that. Um, but nevertheless, I think that a lot of what we're seeing in the natural gas market is just overall risk. It's the risk that Europe is not going to have enough natural gas to make it through the winter. Everything that I've seen, they have over 90% inventory right now. It seems like they will make it through this winter. And with that being said, it's just overall short-term risk of that, and it doesn't appear like that is going to happen. Obviously, another risk is Russia continuing to do something ridiculous. Um, which obviously is a risk that could always happen. But again, I mean, we've already seen the natural gas market has already adjusted to the issues that have gone on with Nord Stream, the issues that have gone on with Europe filling up their inventory for the summer or for the winter. So I think over all and above else, I think that this is just, for in large part, just risk premium in the event of uncertainty. And personally, I like taking trades like this where there is a little bit of an uncertainty because more times than not, it's most likely overpriced. So with that being said, we can actually see how this looks in real time by comparing the relative value. Now, I've done this like 1,000 times, so most people probably know what this is. We're basically comparing the implied volatility for the next 30 days to the realized volatility of the past 30 days. And what this shows us is, is there a true consistent premium that we're seeing? And it appears that there is. We can see this run up that I was talking about at the beginning in July and August, September, and now into October. And we're seeing that this is, in the upper echelon of its range. This isn't the peak. We've seen huge spikes in September. This, by the way, just so everyone knows, back here was when we were really seeing this fear. Um, with everything going on in natural gas a year ago. So like going into 2022. That's when, there was a lot of people there was a lot of issues going on just worldwide with supply issues and things of that nature. Now, what I want to make a point of here is if we go now to the volatility insights tab, I want to touch upon the risks. And we're going to use the term structure tab to really show this and hit this home. So what we can see here on this term structure is we see this hump, right? We see that like implied volatility for the 90 days until expiration options is over 200. So I figured that someone was going to ask this question about, why are we not selling this? And the reason is, at least my reason is, and the reason I don't like it is because I think that, there are still a lot of issues in the natural gas market. Okay, there are a lot of issues, and I think that they're going to start arising. They're going to come to the forefront of, the financial world in the coming months, right? So, for example, after Europe gets out of the winter, right? So 3 months from now, you're talking about, that's January. Wait, no, 1 month, not 2 months. Yeah, it's January. Sorry guys, it's an early morning for where I'm at right now. So, anyway, that's January. And they'll slowly be coming out of the winter, a couple more months, but I think even by then you're going to be able to begin to see that it's probably going to be significantly hard to rebuild the inventories again for the coming winter. So not the winter of 2022, but the winter of 2023. And I think that with that being, culminated with the fact that we're still seeing supply issues on top of the fact that I do think, and this is the biggest risk of why I do not want to sell, it's like 90 DT or 180 or, a whole year out, is mostly due to the United States, actually. The United States, over half of the United States natural gas comes from three shales. Basically, these three shales produce, I believe it's like 52% of the world's natural gas, of the US's natural gas. And, there's this risk out there that, they're showing signs of exhaustion. If you're not familiar with what exhaustion is, it basically is where, it basically is what it says. It's, you're just, there's less juice in these shales basically to get natural gas. And if that is the case, then the U.S. might have to go on the open market and actually buy natural gas. And a huge buyer like the U.S. stepping in could seriously cause some volatility in the future. But again, I don't see that happening in the next between now and November when these options expire. Hence why I think this is probably an optimal trade here. Now, a couple things to touch up on um, before we get to the real correlation, most optimal trading strat. We're just going to touch up on BOIL because that is the one that, I'm liking a little bit more than this one I'm going to show as an example. If we take a look here, we can see that we have extremely positive spot vol correlation. We have a beta of, 0.31. So it show basically what this is getting at is, for every point that implied volatility goes up, the share price goes up X. And when we have positive spot vol correlation, and we're seeing high IV right now, you can play this a couple of ways, right? I always say this, you can play this a couple of ways. You can hedge the fact that if you're short volatility, you should expect the price to go down because as IV comes down, we can see that this is gonna, this regression is most likely gonna lead to the spot price going down as well. So what you can do is, let's say, implied volatility climbs higher, hence price climbs higher. If you sell, say, BOIL right now is trading for like $60. So if you traded, the 65 straddle, at least you're making a little bit of money as the price goes up towards that $65 strike. Now, you can also do the inverse of that, which is if you're extremely confident that this is going to happen, that this premium exists and we shouldn't, this is overpriced and this is going to come in a bit because there's not a whole lot of short-term risks in the natural gas market between, now, because I mean, we're going into winter, then obviously you could, sell a 50 strip or a 45. That way you're making money as the share price comes down and you're making money as IV comes down. There's a couple of ways you can play it. Um, but nevertheless, I just want to touch up on that. Now, one last thing. This is the correlation. All right. So if you go on the correlation finder and you type in BOIL, you're going to see this right there. UNG. United States is the US is a natural gas fund. It's at 1. So basically what this is saying is that, BOIL and UNG move the exact same. They move in complete tandem, complete sync. They are perfectly correlated assets, which would make sense because, the product depth of both of these is that they basically hold the same natural gas futures contracts. From what I saw, BOIL typically just holds shorter dated natural gas futures contracts. UNG has a good bit of diversification with that. But nevertheless, they're completely exposed to the spot price of natural gas and what's going on with these futures contracts. So what is interesting is that if we go to the relative value tab, we can actually see that it's not a lot, right? Which would make sense. I mean, markets are pretty efficient. They would figure this out. If there was a huge gap here, and the spreads between IV30 and realized volatility, I mean, we'd be selling the crap out of one and buying the crap out of the other because that's basically arbitrage at that point. But you can see that when we run this, right? So this green line is BOIL and this blue line is UNG, and what you can see is that they're basically always in tandem, right? If there can be a slight divergence, right? For example, here, but what like it lasts for a couple of days and then that spread completely collapses, right? Completely. Another one here, you can see this one actually persisted for a little bit, but eventually the spread came back in and closed. So typically these move in complete tandem. We're seeing that now. They're moving in pretty much perfect tandem. But if we go to here, right now, we can see that this spread's been flipping back and forth. But I believe like I want to say just God, it was like you know, I believe it was like 10 minutes, 20 minutes ago. I was looking at this and the spread was this. It was like 1.54 to 1.51. Now it's 1.52 to 1.53. Typically though, the premium on Boyle during this rally has been just slightly higher than UNG. So it's the one that I would personally recommend trading. Obviously though, due to liquidity purposes and things like that, because Boyle, if we open up Thinkorswim real quick, you're gonna see what I'm talking about. Boyle right now is trading for a credit, $60 trial for almost, 3 grand. Um, so obviously, if you don't have that much capital on hand, UNG is probably going to be your better bet. But what's nice about having correlated asset classes is that you are afforded the opportunity to kind of trade within your limits. Um, with regards to other risk factors, I really haven't seen much else, but the one last thing we're going to touch up on here, guys, before I let you go, is just analyzing and stressing the position, right? This is extremely important, especially with a trade like this, where obviously something could happen. I strongly suggest that you guys take a look at this as well. Um, Taking a look at your own assumptions. If you don't have a view on if you don't think this is like a consistent premium, if you don't think that this is an optimal trade, don't take it. Because at the end of the day, these types of trades, you need to have that conviction yourself. But nevertheless, stressing this position, we can see that if we held this November option position till the 18th when it expires, our break evens are $30 to the downside and $90 to the upside. Yeah. It's ridiculous. Volatility adjusted here. If we plug in our forecast volatility, if you want to see this in the PA terminal, you just go back up here to the Volatility Insights tab, and obviously we just need to type in Boyle real quick. Do this. Sorry, guys, one moment. There we go. So now what we have here is the forecast volatility for 30 days for Boyle. And this is typically what I do with Thinkorswim, just to stress test to see how much, we should expect to make at every given instance of wherever the stock price is at, assuming the volatility comes into around this range. So we've actually seen has actually ticked up a little bit even more. Because when I ran this 25 minutes ago, it was right around the 108, 109 mark. So we're still seeing IB kick up a little bit. Um, Nevertheless, though, guys, besides that, the risk measures and finding optimal trades, right? And I made that point, and I would just want to hit it one last time before wrap this up here. When trading things like this, okay, where we go through and it's so tight, at this point, what it allows you to do is it may not even be the most optimal in this specific instance, right? It could, if this spread, came back like when I was looking at it, hence why the title, it was at like 1.54 to 1.51. Yeah, that's more optimal because it's the same thing. Now, when it's like this and it's so close between the two, because they're basically the same thing, UNG and Boyle, you're kind of afforded the opportunity of, well, how much, like nominal exposure do I want? Let's say I run a small account. I don't run a large account. Let's say I run a really small account and I run like, like not even 10,000. Okay. Well, it's going to be really hard for me to trade Boyle, right? You're receiving, each straddle is going for 3 grand, right? For November options. So that is extremely difficult to trade. So, that's why UNG provides that opportunity because you're getting the same exposure. You're getting the same exposure to the same commodity, to the same volatility, to the same level of premium, barring a few bips. So I really hope that you guys understood that part. If you guys have any questions, always feel free to message me. And yeah, I look forward to seeing you guys in the next one. Peace.